Good afternoon, ladies and gentlemen, and welcome to today's, of course, our regular Friday scheduled session for our open forum Q&A session for all things options related, of course, and all things market related as well. Before we begin, we also want to start off with what is Power Options? Well, Power Options is a patented suite of search and analysis tools designed for self-directed options investors. Our tools will allow you to search across the universe of options to identify only those positions that match your personal risk-reward tolerance in a given strategy. Once, of course, you have identified those positions, you can do further research and analysis on the stock or the option. And, of course, we also offer a powerful set of portfolio tools to help you paper trade, track, and manage your positions. In addition to that, of course, we do offer countless educational articles, help videos, educational tutorials, and archived webinars to help you get more familiar with the tools on the site and the various option strategies. Ernie Zarena created the Power Options tools back in 1997. Of course, we've done a lot of updates since then and upgrades over that time in the past 20 years. And everyone here on staff uses these tools to trade their personal accounts, myself included, so we have many more years of combined trading experience. Now, our process and procedures for this afternoon's presentation, when you logged on to the webinar, the GoToMeeting, GoToWebinar platform would have appeared on your screen. Inside that platform is a question pod, so just use the question pod to send us a question at any time during the presentation. Please feel free to ask as many questions as you want. We are scheduled to be here from 4:30 p.m. to 5:30 p.m. Eastern Time. But if we do have a high volume of questions, I'll be more than happy to stay online to make sure that all questions are answered. Your questions can really be about anything related to options investing. If you have questions about general options strategy, getting into a certain strategy, a covered call, a bull put, strangle perhaps, or if you have questions about the trade management, rolling a covered call, adjusting a cash secured naked put. I had a gentleman on the phone yesterday I might take a look at today in regarding a certain position, and Bill just sent in a question as well regarding a trade management, and we'll get to that too. If you have questions just about option specifics, what is delta, what is gamma, what can I expect if my stock moves up 10%, will I have a gain on a certain call option? Popular question that comes up: if I bought a call and the stock moves up 8% in the next 15 days, what can I expect as my return? And of course, if you have questions about the specific tools on Power Options or the concepts of the RadioActive trading techniques, feel free to ask those as well. Our basic ground rules: don't be shy. Please feel free to ask any questions that you want at any time during the webinar. We'll check the question pod on a regular basis. Be patient. There might be one or two questions ahead of yours, but as I mentioned, we will get through them all. I also want to encourage you to feel free to help us help others. If a question comes in and I give a response based on my market experience, what I've done in my personal account or previous discussion with clients, but you feel there's a different way to approach a position or to look at a specific view, I encourage you to use the question pod to send that to us, send us your ideas, and we'll of course share that with the rest of the audience as well. Most important, let's have fun. It's the end of a short trading week as the market was closed on Monday. We've seen some interesting increase in activity over the past few days. The market was down this morning, but most of my stocks rallied and were actually up by the end of the day, but I know not every stock was as well. So let's have some fun. Let's get some good education under our belt, get ready for a nice relaxing weekend, and then get ready to get back into trading on Monday as well. Okay, well, what I'm going to do now is I'm going to go ahead and navigate over to the Power Options suite of tools. That's the format we're going to use, of course, to go through and for visual examples of the various strategies and the various ideas as well. I'm going to keep it over here. Okay, I'm going to do that there. There we go. Okay, and let's see. We're showing the Power Options screen? Absolutely, yes, we are. Okay, so the first question that came in is from Ben. Ben wants to know, I bought NVIDIA at 114. It's now at 101. How do I fix this trade? Okay, well, one of our signature tools that we have available on Power Options is what's known as the stock repair tool. The stock repair tool is going to try to build a ratio call spread to help us get the position back to break even faster. In addition to that, some of the other tools we have here, the market sentiment tool, the volatility skew, spread chain, a long option finder for seeing which is the best call option, which call option will give you the best return based on your expectation of the stock, and of course a tool for insuring your stock positions. But right now we want to go into the stock repair tool. First, I apologize, we're not going to go to the stock repair first. First I'm going to go to custom spreads, and BIN has NVIDIA and NVDA at a price of 114. Now, we could try to manage this. It's down to 101. We could try to manage this by selling calls against it. Let's go to standard March expiration. And, you know, we're not going to be able to get $14 right away. But with a stock at 101, maybe I could sell the 105 call, and we'd get about $2.05. Okay, so let's just go ahead and put that in for the covered call position. Now, this is going to reduce our cost basis down from, of course, 114. Sorry, folks. This would help if I put in the proper number of shares, wouldn't it? That's much better. All right, so this is not a good fix. We're still going to lose 6.2%. We are going to lower our cost basis in the position down to 111.95. Doesn't address the downside any further. The stock repair won't either. But with our stock trading at 101, is there a way now that we can maybe get into a position to fix this? Okay, well, let's go back to the signature tools. Let's see what the stock repair has for us. Stock repair tool is fairly easy to use at first, then we have to do some description. So put in our stock symbol, NVDA, $114 cost per share, and we're just going to use 100 shares to keep the math simple. Now what this tool, not great, but not bad, okay, not bad. What this tool tried to do is build various ratio repairs where we're going to sell 2 calls and buy 1. Now, if you can't do a ratio spread in your account, you still may be able to do the stock repair because your broker could just see it as a covered call with a bull call debit added. Now, in general, we want to do this at a credit. And as we see here, let me just highlight this. As we see here, what this tool attempted to do was build ratio call spreads for March with different strikes. It found positions that would give a net credit, but it did not lower the break even. Okay, in other words, it'd still be assigned for a loss in those positions. We don't see any in April, unfortunately, either, but that's okay. We go down to May, and we see that we have a few positions here where a new break even has dropped down to 104.70 with a net credit of 460. And we also see ones here at lowering the break even to 106.55 with the 100, 110. I'm going to take this first one, the May series, and first I'm going to click on Repair Details. Now this gives us a breakdown of the repair that was found for us. So we know we had on a cost basis of $11,400, $114 per share per our 100 shares. Of course, NVIDIA is at 101.57. We currently have a loss of $1,242.90 for 100 shares. Now, we're shown that we can buy 19th of May, standard expirations, probably about 70 days out in time, for $9.30. And at the same time, we can sell 2, selling twice as many May 105 calls for $6.95. So we're going to pay $19.30, we're going to get $13.90 back, so we're originally going to receive a net credit of $460. Now, if we have a cost basis of $114 and we take in a net credit of $460, well, that means our break even should be $109.40. So that's a little bit better. We're still taking a good credit in here of $460. And you could say, well, why don't you just sell the $6.95, the 105s at $6.95, or the 100s at $9.30 to bring this down to 105 or essentially to 107. Well, we already saw how that still might not result in a profit when we went further out because we're selling a 105 call. And if we sold the 100 for $9.30, sure, we reduced the cost basis to $104.70, but we sold a 100 call. It's a potential loss of $470 to the upside and still no downside protection. So We lower our cost basis to 109.40, but how is the break even at 104.70? Well, it's because of the structure of this trade. Remember, we bought one call and we're selling two. So essentially you did a covered call against your stock, but now you also have a bull call debit spread. It's a 5-point difference between the 100 and the 105. And of course you do this essentially at a credit. So what happens if our stock is at 104.70? Well, we have a loss of $9.30 on the stock. We own a 100 call and we've sold two 105s. So our two 105s expire worthless at May expiration, and our 100 call is worth $470. We could sell to close the 100 call for $470, and remember we did this at a credit at $460. So here we are, 104.70, back to break even. We've countered the $9.30 loss on the stock, and of course if it's trading right at 105, we have a max profit of 60 cents. Now, that might not sound very attractive, and it is out to May, which is about 75 days away. Okay, but let's go back up and let's look at analyze trade. Let's see this graphically now that we've run through the description. So we have 100 shares of stock at 114. We're buying one May 100 call at 930. You're selling two 105 calls at 695 for a total of 1390. So here's the repair. But remember, this right here is at 105. Your original cost basis was at 114. So you could get back to break even faster using the stock repair only if you need the stock, and I'm sorry, you only need the stock to move up to 104.70 or 105. Now again, this is roughly about 70 days out in time. Shorter term repair could not be found, and it's possible that NVIDIA could continue up. But this is a way to get back to break even faster. Using the stock repair tool, we only need the stock to go up a little bit now, only $3 instead of going back up $10 to our break even. I'm sorry, $13. And let's see, as I mentioned, oh, it's 84 days out in time, not 70, my apologies. So it's 84 days out in time. So that's a bit extensive, but it is a way to get you back to break even faster. Now, what are some of the drawbacks of the stock repair? You do end up with a cap gain. So if sometime in the near future, let's say in the next 20 days into March or even into April, there's a sudden gap and the stock goes up to 110. Well, you'd have a profit now of 60 cents, 0.5%, where you'd still be at a loss of $4 on just the stock from your original purchase price. It does cap the gain because remember, we do have a covered call. We've sold a 105 call, but we're getting the benefit of this bull call debit spread between 105 and 100, the other short call and the long call. That's the $5 we can get back to get us back to break even faster with a net credit of 460. But this, of course, just like selling a call against it, does not address the downside. If the stock continues to fall, you still could have a loss on the position. So the first thing, Ben, is to ask yourself, what do I think the stock's going to do? Am I bullish on this stock? It maybe fell because of earnings, and it may be pulling back because the market has pulled back the last 2 days, although, as I mentioned earlier, there was a recovery today. Now, Ben, you bring up a good point. You could say you could buy a protective put on the downside. You're right, but what are you going to do if you pay for a put, let's say at the 100 or the 95 level for May? You're going to negate the 460 credit or some of the 460 credit you just received, so this would not be a break even. It'd still be at a loss. Okay, we can look at that. Let's add in a protective put at about the 100 strike for May. We'll keep it the same expiration month just to keep things simple. Remember, our net credit was 460. 100 put here is 740. So if I add that in, or let's say we even did the 95 put at 520, we've now totally negated the net credit of the repair, and we could still lose $480 if the stock's at 105. And here where the stock is now, let's say 100, you're still losing 1303, almost even to your loss that you have right now. So that's why the repair is not shown with the put to the downside, because it would negate that initial net credit we received and it wouldn't give us the benefit. So you're right, it is a drawback. The stock repair doesn't, but the downside, if you add a protective put, in this case if the stock continues down, you may still be in a position where you could lose in both directions. Okay, so the stock repair is best used if you feel the stock's going to recover in time. This is only 84 days out, so it's a longer time horizon, and it's only a move of 4 points. And I'm not going to say this is a bad repair at all. It's a great repair because I only need the stock to go up to 105 in the next 80 days to get back to break even rather than 114. But again, the stock repair works if you think the stock's going to recover. Now, that all being said, that's one way to look at it. We already talked about how we could just sell calls against it. You know, we couldn't sell the 100 because this would lock us in a loss. So would the May 105, so would the Aprils and everything along those lines. But if you chose the 105 for 20 days or 30 days out, got $2 because you didn't think the stock was going to go back up to 105, it expires worthless. Well, now you've knocked your cost basis down to 112. And then you do it again for another 20-day period, you knock it down to 110, provided the stock doesn't go above it. Okay. Now, all of that being said, I'm going to go here to the free webinars tab, and I'm going to send you a link here to everyone. It's www.poweropt.com/webinars.asp. This is the free webinars page that we're looking at right now. And what I want you to do later on, Ben, this weekend, if you have the time, go to poweropt.com/webinars. There's only one B in there. I'm sorry. Let me type it again. Ignore the first link, folks. poweropt.com/webinars.asp. That's 1B. There we go. It's the link right up here. And if you go into options concepts, there's a full video here on managing your broken position. Yes, it's a year old, but it's the same material I would teach if I was showing this webinar today. So in that webinar, we go through the alternative methods for managing a stock position that has fallen in price or a covered call that has moved against you, managing a sold put, a naked put that is now in the money, conversations on bull spreads as well. So we'll go over the stock repair again in this, but we'll also discuss other ideas of managing your broken stock. I don't know your cash situation. I don't know your account size, but you might be able to get a better stock repair if you average down, if you have the capital. I'm not always a fond proponent of throwing good money after bad, meaning adding another $10,000 to buy another 100 shares of NVDA. But here what I want to show you is if we bought another 100 shares at 101.50 and with our cost basis of 114, we're going to have a new cost basis of around 107. So now you have 200 shares at 107. You could plug that into the stock repair, and I'm sure you'd see some opportunities maybe with the 105, 110, or even the 100, 105 that would help you get back to break even. Yeah, I'm sorry, it would be closer to 108. But let's do that. Let's try that very quickly. Let's say you did average down. You bought another 100 shares. I went to the wrong link. My apologies. Let's go to our stock repair. So NVDA. Cost basis of about, you know, it'd probably be about 107.75, I guess. And we had 200 shares. So we averaged down by another 100 shares at 101.57. You do see some March repairs here, shorter term, where your break-evens at 104 and 104.32. So it's another idea that's discussed in the webinar that might help you get back to break-even faster, averaging down. But again, these repairs only work if you feel the stock's going to come back up in price. In that webinar, I do discuss some other things you might want to consider if you think the stock's going to continue down. It might not be the best repairs. They might set you up for another loss in a different direction if the stock does recover. But again, it depends on your outlook. I can't tell you which direction NVIDIA is going to go next. I can show you what's possible with the tools that we have available for you to do all the heavy lifting, how you can get back to break even faster. But again, solely based on you feeling the stock's going to move back up in price. If you think NVIDIA is going to move down, you may just want to buy a put and close out of the stock and see if the put profit that you make counters some of the loss that you took on the stock position initially. But again, that'll be discussed in that webinar. So it's in free webinars, the options concept tab, manage your broken position. Okay. All right, so Lionel asked the question. He's getting new and getting introduced to the radioactive trading techniques. Actually, before I get to your question, Lionel, I know you've been waiting patiently for about 20 minutes now. I'm going to do something else real quick. I want to check something for the coaching session I had earlier this week, I had a client who had an option on MOMO. I just want to see what the stock, oh, not bad at all. Okay, I feel happy about this. The stock had pulled down $1.30 yesterday, I think it was. Yeah, $1.21, and at one point it was lower than that. The stock had been trading at around $27 on Wednesday, I believe, $26.80, $26.93. Well, the customer had the 26 naked put for today's expiration. So yesterday he was looking at a profitable position he could have bought back for about 10 cents to having to consider buying it back at a much higher price there. It was during the day it was at close to $1, yeah, with the wide bid-ask spread. But today he probably could have closed that 26 put with a stock at 25.86 or maybe only 20 cents or 30 cents. Bid-ask spread is really wide, but I just want to see that. So our discussion was what repairs could be done when you sold a naked put. And let's take a look at that real quick. If we just did that MOMO, the 26 put for today, I don't remember his original premium. I want to say it was around 75 cents. But, you know, for those of you doing naked puts, what do you do if the stock's below it right at expiration? It suddenly just goes below it at expiration. And if I selected sell, we'd see a naked put profit and loss chart there. So now that it's below, you know, depending on what I think the stock's going to do next, he could have probably bought it back and still made some profit. Maybe he had to pay 30 cents or 40 cents, but, you know, still made 1.5% of the 75 cents with the stock being up to 25.86. Could have rolled down the put, bought it back for 30 cents, and rolled down, let's say, to the next week out or 2 weeks out, maybe 14 days, go to the 24 put to get some return with the stock at 25.86. Or we could have taken assignment and converted it to a covered call. So we would own shares of stock at 26. He keeps the 75 cents, so he's got a cost basis of 25.25 on a stock that's trading at 25.86. Now he maybe could sell the 25 call for $1. 2 weeks out, what would the 25 call be? Yeah, $1.80, $1.90. Okay, so he's giving up 25 cents of intrinsic value, but you're getting $1.90 back. So you could still get assigned and earn a profit, a fairly reasonable profit on that position. So I was just hoping that the stock had rebounded for him today rather than drop down again and be below 24. We might have paid $2 or $3 to buy it back. Okay, Lionel is asking a question now. He's new to the radioactive trading techniques. He's maybe seen a few webinars there. And he wants to know how far out should a married put be placed. When we do the radioactive trade, we're going at least 150 days out in time. The default criteria that I select from when I place trades in the Fusion portfolio at Radioactive Trade, my actual positions, or when Ernie places his trade at the Fusion subscription at radioactivetrading.com, they're grabbed specifically from this list. I'm not in any of these right now. I like Cooper Tire. That's one I'm interested in. I had a good trade on Goodyear last year, Goodyear Tire. E-Trade is one I was considering recently. I'll have to take a look at that. Nice risk of 6.6%. I don't think I have a view of it available, but I'll search for it real quick. Why are we going 150 days out in time? And it's because of the decay of the options. And it's also because of the static idea, I don't know, that's a bad term, I'm sorry, sort of a golden rule of options. There are a couple golden rules of options. The first one, Lionel, of course, is that the time value goes to 0 as you approach expiration. Well, that's obvious, but that's a given. It's etched in stone. The time value is going to 0. You might have some intrinsic value left. If you're out of the money, it's going to go to 0. But as you get close to expiration, your extrinsic value or time value goes to 0. Another general rule is that when you're selling options, you want to be selling week by week or month by month to get a better annualized return. And when you're buying options, you want to be buying farther out in time because you pay a lower annualized cost. The option that is 6 months out in time is not going to be 6 times the cost of the near-term option. I'm going to stick with E-Trade. We're going to look at that. This is a January 40. That's 329 days out in time. But we're going to go to the option chain very quickly for the puts. And it is a small chain. But what I want to do is I'm going to go to March, which is 21 days out. I'm going to push hold on that. And we're going to go to October, which is 238 days out. June's a little bit close. I might go with a June, but it's a little bit close. It's not quite 150 days. I think it's 146 now. But we'll add June, and then I'm going to add the January 19 as well. Okay? So why am I showing this? Remember, we were looking at the 40 strike put. That's what came up in the search results. We want to be slightly in the money to get the best results. The March 40 strike put is a bid of 310 to 365 if I was buying it. Or selling it, but yeah, the March is at 310 to 365, 55 cents. Oh, let's just call it a midpoint of 340. Okay, let's say we could get 340 for that at midpoint. And our option is $3.20 in the money. So there's a low time value. Yeah, it's a time value. I'm sorry, folks. Let me scroll up a little bit so we can see the data columns. That would help, wouldn't it? All right. So yeah, but at 340 at the midpoint, you know, it would have some time value. We're looking at $3.21 in the money for the 40 strike. Let me clear this up here again. There we go, perfect. So right here, we're calling on it 340, okay, what we would likely get. The option is $3.21 in the money, so we've got 19 cents of time premium. But the full price of this option for 21 days is 340. 10 times the amount out in time to October, 238, the 40 strike put is only at 520. All right? So we've gained 220 days of time and only $2 more in cost basis, a little bit less, $1.80. And if we go all the way out to January, which is 329 days out, 575 to 605. So let's go ahead and call that 595, an increase of 70 days, or what we might call 3 months, only goes up 75 cents. Okay, so the rule here is that the option that is 10 times out in time in this case, or we could say 7 times the amount of time, 7 months, is not 7 times the cost. Okay, so when I'm selling, I want to be selling here in the short term. When I'm buying, I want to be buying out here. Now, let me pause the screen real quick. I'm just going to do, oh, sorry, folks. Give me one moment. Something basic here. There we go. Sorry, we're going to do something simple here with the wonderful internet. I'm just going to pull up an image real quick. I don't have one saved on this computer. I have one saved on my office computer here. I'm actually at home right now. Okay, so let's clear that out. There we go. Okay, here it comes. Let's see if this looks good. Okay, so what you're seeing now, this is just a typical Google search, and you can look this up at any time. This is the image I actually use just straight off the internet for some of my webinars and some of my presentations. But this is showing you the time value decay of an option. And here's your days here. No, it's not the best image, but here's your days. So at 30 days, we start to see the rapid time decay. Assuming that volatility, of course, and everything else stayed the same, 30 days out, you know, I sold an option for $1. I'm going to see the most time decay in that last 30 days. Really, the last 15 days is when you see the most of it. Those last 30 days is when it starts. Well, really, 60 days is 45 days when we start to see that curve. You know, right about here, we start to see that curve. Okay, so what does that mean? When I'm buying a married put, radioactive trade, I want to put time on my side. And I want to also give the stock time to move in my direction. So in the worst case scenario, if I bought a put that's 150 days out in time, out into this block here, and even for the first 60 days from 150 to 90, the stock does nothing. It stays where it is. Volatility wouldn't stay the same. It would probably be declining. But assuming that everything stays the same and my stock stagnates, I'm not going to lose that much time decay in the first 2 months. Okay, that's important because that still allows me to do manipulation. I could maybe bring the put closer in time. I could do other adjustments to the put because they haven't lost that much time decay. Now, as I start getting to 60 days, we're starting to see a little bit more. And then as we saw that last 45 days, it really kicks off. Okay, so that's why I want to start at least 150 days out so that the time value I can still manipulate in my favor, even if the first 2 months the stock does nothing. It doesn't move at all, okay? And there's other versions of it here, but this gives us the illustration of why I'm buying further out in time. If I'm bullish on a stock and I enter the married put position, let's go to our Cooper. Oh, I'm sorry, was I on Cooper Tire? I was on E-Trade. Let's go to my E-Trade position. And let's go to the profit and loss chart, of course. Now, this is a risk of 6.6% for a deep in the money January option. I might go closer in time based on my anticipation of E-Trade. Instead of going to the 40 for January, I might go to the October 38 or 39. I'll go with a 38 with a price of $4 instead. See how that looks for me. Yeah, still about the same monetary risk, but I only have 238 days to expiration. But I'm closer to the current stock price. I like this. Sorry, I don't mean to babble. I've been looking at E-Trade for a while. I do like this October 38 put. I may open this on Monday for our Fusion subscribers if the stock stays around the same price. If we had earnings yet, let's check the stock research tool. Yeah, so the next earnings aren't until April 20th. And I'll do a little bit more research on that. But this is a nice married put setup. Good 6.8%, under 7%, 238 days out in time. Now, I'm paying $4 for the put, but I'm about $1.21 in the money, so my max risk is only $2.79 out of $4,000 invested for 100 shares. Let's say the stock stays at $36.79. Volatility remains right about the same, but let's say 2 months from now, so it put us right at about April 24th. And let's go ahead here. See, even if the stock stays at the same price, theoretically, Black-Scholes pricing model, 2 months from now, from if I get in, okay, well, I get in on Monday, the 27th, but 2 months from today, the expectation is I'd only lose about 43 cents on the put option, less than 1/10 of the value, even though 2 months have passed, okay? But we go to 60 days from our expiration of 10/20, let's go 90 days. Okay, so let's go to July 20th, 7/20, and the stock stays at the same price. We'd be down more than 1/4 of the price. Okay, so that's the time value rate. I'm only losing 43 cents maybe in the first 2 months, even if the stock stays at the same price, assuming volatility remains the same. But if I hold it out to July and the stock stays at the same price, I'd give up 1/4. But by the way, so at this point I could sell to close the stock at $36.79, sell to close the put for $2.77, so I'd lose $1.23. That's less than half of my maximum risk, and the stock hasn't done anything for me, and I'm still near to expiration. I only lose 3% on it. But of course, by that time, I probably would have sold, done another adjustment in this case. Okay, first 20, 30 days when I first analyze it. So, is it better to go 1 year out, 2 years out, 8 months out, where we kind of are with October, or stick to 150 days, which is just 5 months out? My average is about 210 when I open a married put. So a little bit more, about 60 days more, 2 months more than that 5 day out time. 7 to 8 month period is usually my average when opening a married put position. And it's because even if I'm wrong in the first 60 days or 70 days, I'm not giving up that much. If I was willing to take a maximum risk of $2.79, well, I'd be just comfortable taking that risk of 43 cents after the first 2 months, even if the stock hadn't moved. I'm pretty sure I can stomach that and make adjustments or move on to a new position as well. Okay, so that's one of the 3 core principles of radioactive trading. I've got a webinar on that as well, but I want to go at least 150 days out in time. I want to kind of keep my risk between 3.5% to 7.5%, and I don't want to go more than 15 or 20% in the money because that lowers the expectancy. I can change the technicals and fundamentals any way I want based on my portfolio size and my needs, for example, but in general, when I'm looking for a married put, I'm going to keep this 150 days minimum. I'm going to keep my risk controlled, and I'm not going to go more than 20% in the money or more. Okay, so that's a long answer of how far out you should go. Okay. All right, so Michael asks, a follow-up to this, where are you making money? So what if the stock does up a lot, then you still lost money because the put will be worth a lot less? Okay, Michael, I don't know if you've ever traded long calls. Let's go back to the custom spread tool. In this particular position, what we have to see here is that, remember, I am not down $400 when I open this position. Is my break even 40.79? Yes, at October expiration. If I hold the position all the way to October, make no adjustments, and accept no dividends if E-Trade pays a dividend, then yes, I need the stock to be trading at 40.79. But the moment I open this position, I'm not down $400. I'm not down $279. If the stock stays around the same price for my Fusion subscribers, I'm probably going to open E-Trade with a cost of, let's say, $36.79. I'm going to look at that October 38 put for $4. If the stock gaps up to $37.25 or $37.50 on Monday, then I'm going to buy the 39 put, and I'll still probably have the same monetary risk but with a different strike. Okay, but let's say, Michael, that I open this position Monday at 10 a.m., lack of a better term, and I get these prices. And I decided, whoops, I didn't want to do that. Okay, the minute I open this position, I could turn around, sell the stock for $36.78, $36.76, and sell to close the put for $3.95, $4.05, $4. All I'm risking when I open this position is the bid-ask spread. And we saw it was pretty tight when I looked at it on the chart there, okay? Now, you can say that this looks a lot like the profit and loss chart of a long call, and you'd be right. And what does a long call offer us? It offers us a way to get into the position or to take advantage of the stock movement by having a lower cost. So it might cost me $285 to buy the October 38 call. Okay? Well, I can tell you what it is. Let's find out what it actually is. All right? So I'll go to October 38 call. Oh, I'm wrong. Shoot. Okay, well, it's not too bad. It's a little bit higher than I expected. So 290 to 320. Hey, we're going to call it 305, midpoint. Okay? All right. So if I bought the October 28 call, I'm sorry, October 38 call for 305, roughly, okay, I'd have a similar risk-reward profile where it looks like this. What do I know about this call? It's an out-of-the-money call, so my delta is probably going to be right around maybe, I go 0.45, maybe 0.4. So what does that mean? Well, if the stock moves up $1 from $36.79 to $37.79, my call is going to increase in price, isn't it? Yeah, it's going to gain 40 cents. Now it's going to be worth $3.50. Same thing happens here on my married put. My stock has a delta of 1. My put has a delta of maybe negative 0.55. So overall, I have a positive delta of 0.45. If I open this position on Monday at 10 a.m. and by the close, the stock's trading, let's say, at 37.20, okay, so it moved up 50 cents, my put's going to lose about 30 cents. So I still have a positive gain on the position of 20 cents, okay? Because I'm not, this money didn't disappear that I paid for the put. This doesn't disappear. I'm still in a positive delta position, and I'll still gain money to the upside just as you would on a long call. Why are they not parity trades? This gets questions that gets asked a lot, excuse me. So side by side, if I bought this at 305, I'm risking 305. Well, it's not that much different, 30 cents or so, okay? On 27 cents, 26 cents, excuse me. Okay, so that's just the difference between the two. But remember, on the long call, you're risking 100% of what you invest. The benefit of the married put is it kind of protects me from myself. If I had a $40,000 account and I have $8,000 to trade right now, let's call it $8,200. Let's call it $8,200 to trade out of a $4,000 account. Okay, so I have $8,200 and I have a $40,000 total portfolio, maybe $50,000, whatever. If I was going to open this new trade, I could afford to open 200 shares, 2 puts. That would put my cost basis, you know, a little bit above 8,150, sort of. Okay, 58, right? 40.79, 200 shares. My risk would go up a little bit higher, still within a reasonable range, but it would go up to, what is that, 558? Yeah, yes, of course, 558. You know, I'm guaranteed to get 38 backs. That'd be 7,600 backs. So my maximum risk is 558. Okay, so I've taken about a third. I'm sorry, a fourth, almost a fifth of my total portfolio to invest in 200 shares in this position, but the monetary risk of those 200 shares is about 1.4%, 558 of my total portfolio value. It's forced position sizing. So even if this stock collapses, goes to $2 per share, I can't lose more than 6.8% or 558 of the 200 shares I invested, which comes out to be 1.4% of my total portfolio value. Okay, I can stomach that loss and be perfectly happy. Now, on the other side, you have a $40,000 account, okay, and you have $8,200 to invest, and you say, well, I'm not going to be stupid. I'm not going to trade almost 30 calls, 28 calls at 305 to invest the full 8,200. I know you're not going to do that, but what are you going to do? You're going to buy 5 calls, perhaps, maybe 4 calls at 305, so you're going to have a $1,200 or $1,500 investment on your calls on ETFC. But you're risking 100% of this. We are no longer at parity. Okay, even though the risk-reward profile looks similar, we've got the same positive delta of 0.45. You're using leverage. The common result of a person using leverage is to overinvest. Okay, the common action, I should say, is to overinvest. So let's say that you decided to mimic exactly what I was doing. We're not quite even, but let's say you got a better price. Let's say you got $290 for that call. Your broker was really good at getting you filled, and you only bought 2 contracts. So you've got a total cost basis of $580 into 2 calls, 2 October 38 calls on E-Trade. You say, all right, now we're close to parity, and I'd agree with you. But then what do you do with the remaining $7,620 that you have available? You're going to buy 5 calls of stock XYZ, 3 calls of stock ABC, 4 calls of stock 123. Now we're not at parity anymore. These are not parity trades of one another because you're risking 50 to 60% or however much you invested of what you had left. But remember, if you go as high as $1,500, $1,600, you're risking now close to 5%. And if you use most of this 8,200 to spread across different calls, number one, the return if E-Trade moves up 20%, yeah, you'd make 20% on this, but it would be muted by the others that had a little loss, had a little gain, and so forth, okay? And at the same time, if you do that total 8,200 in long calls, if there's a market turn, you could quickly see you're losing close to 100% of that 8,200 you invested. Let's even call it 7,500 that you invested. Because remember, if you see a 10% drop in a stock, that's going to be a 30% loss on your leverage call. Leverage works both ways. 5% drop in the stock, you're probably losing close to 20% on the option itself. 5% drop in the married put, I'm probably in the first 20 days, I'm probably only losing 1.5 or 2% of my total investment. Okay, so when the stock moves up, I still have a positive delta. And remember, what happens to a long call when the stock moves up? Well, after the first dollar, the delta increases. So the stock moves up to 37.79. The delta of my 38 call is going to be closer to 0.5. It moves up another dollar, my delta is going to be 0.6. Well, I'm in a stock and a put, so as the stock continues to go up, this delta would drop. After the first dollar, my delta would be negative 0.45. It moves up another dollar, it might be negative 0.35, so I'm also gaining more dollar for dollar as the stock moves up. Okay? So that's why it's a positive delta trade. The quick answer is a positive delta trade. I just wanted to illustrate it completely, which got confusing with all the numbers. But it's key to remember that although this looks like a long call, and as the stock moves up, I'm going to make a profit on the position because I have a positive delta, this is not a parity trade to the long call. The parity trade is if you bought 2 of those October 38 calls and then put the remaining $7,000, $7,200 you would have used to buy the stock on hold in your account. Now you can say that we're at parity. But the minute you start buying more calls, you start using that other capital to invest in other positions or spread trades or things of that nature, you can't say we're at parity anymore because you're risking more of your portfolio to the open market where I'm only risking 6.8%. Okay, and that's in the worst case scenario. I'm probably going to get a better price here for that put as well. Okay, but just as an illustration, let's say 15 days from now, the stock moves up. Let's say just to even 37. We just gained 21 cents in 15 days. Okay, so that would put us at 13th, I guess, right? Yeah, we'll call it the 13th. How about that? Okay, so the stock moves up just a measly 21 cents in 15 days, and I'm still right about at break even. I didn't lose money. I'm not down $279. I'm not $279 behind the 8 ball when I start the position. Okay, and I'm not $400 down either. Because just like when you buy a call, you know that as the stock stagnates, you didn't lose the 305 you paid for it. You might have lost 20 cents, 30 cents, or so forth. It's the same way with the married put. So as the stock moves up, let's say it moves up to $38, $1.21 in those first 15 days, well, it shows here I might gain 121 on the stock. I don't think I'm going to lose as much as $69. In fact, I think I'm only going to lose about 60. But yeah, I'm going to have a profit on the position. And that's not my goal. Okay, my goal on these married put positions is usually to not get 10% on each one, but in general, that's my goal for the year, is to see the portion, the radioactive trading portion of my portfolio, the married put portion of my portfolio go up 10 to 12% per year. Missed it by a little bit last year. I was up 9.4% with the married put trades. This year, I'm actually behind where I should be, and it's because of two factors. Number one, selling a call. I have 3 positions that are up double digits. I sold a call on them. I shouldn't have. Okay, I have to buy the call back for a higher price now, so it's going to cost me more. The other one was just I played an earnings play, and I played it with a married put with protection in place, which was great, but I should have done a synthetic straddle on it. The stock dropped about 20% in 2 stages. It dropped 15%, and then it dropped another 8%. It went from 64 down to 48. Now, I'm only losing 5% on the position, and I'm long the stock, and it's down about 20%. Had I done the synthetic straddle, which I should have done, what we call income method number 12 in the radioactive trading techniques, I'd have a profit of right now close to about 17% being long the stock and the stock being down 20%. Is it 20%? Let me check here. I want to say it was 20%. Ah, shoot. I don't know if I have it in here. Yeah, I do. Yay. 19.7%. I'm sorry. Ubiquity is down 19.7%. I'm sorry. I'm losing right now 5.5%. 5.7% on the position if I liquidated. But it's down. I've been long stock and it's down 20%. And then the other positions, of course, 10% up on advanced, Allies up 16.2%, and eBay I'm in right now, and that is up about 15% from my cost basis as well. But I damaged 2 of these trades because I sold a call. I have to buy it back sooner and pay more money to get into the position. Okay, so Michael, I hope that answers your question about how does the married put make money. This thing that you're used to, when you analyze a covered call, if I bought a stock at 20 and sold a 20 call for $1, I know my break even is 19. I don't want the stock to fall below there. Well, you might look at this and say, well, your cost basis is $40.79, your break even is $40.79. You're not going to make a dime until the stock goes up to $40.89. And you're right. If I hold the position all the way to October expiration, make no adjustments on the position, and accept no dividends, you're right. I need the stock to be trading at $40.79. But that's 240 days away. That's the only time the break even comes into play on a radioactive trade, married put position that we're talking about. We showed that it had positive delta, and that right now I'm not losing any money on the put except for the bid-ask spread. I could turn around and sell it right away. So it's a bullish position. I agree with you. I need the stock to move up. I'm looking for stocks that I feel, when I open a married put such as this, it's because when I further research E-Trade out of the list that was available, it's that I feel that this stock has the potential to move up, let's say 3 to 6%, maybe 3 to 7% in the next 20 to 30 days. And that's why I'm going to do it. Okay. Now, yes, I'm buying a put that's that far out in time to keep it in single digits and to put time on my side. because if the stock doesn't do what I expect and meanders here about $37 or so for the first 20 days, I'm not losing that much. We already saw that. I'd be losing about $1, 1 cent. Or if the stock went up to 37, yeah, I gained 21 on the stock, 21 cents on the stock. I'd only lose about 22 cents on the put for time decay. So I'm still at right around break even. And that's how we make money. Now, let's say that if there's a rise, let's say there's a good rise. Let's say I get that 5% gain I want to in the first 20 days. So we'd be looking at a position here. Let's call it 5% would be about $1.80. So let's put us up at $38.50 on the position. So the stock moves up roughly $1.80, goes up to $38.50. Well, let's call it $38.60 actually on 3/13, about 20 days out. Well, I'd be making close to 86 or 90 cents. Again, 50% of what I expect to make just holding the stock by itself. Someone asked, well, if that's your goal, that you feel the stock's going to move up 3 to 6% in the first 20, 30 days, why are you wasting your money on the put? Shouldn't you be just buying a call or just buying the stock? It's because I'm not always right. Ubiquity Networks, for example, dropped 20%. That was not my expectation for the stock. That one did meet my expectation, by the way. I actually got in at 61.75. It moved up to 64, and then the earnings happened, and then it collapsed. But I've had stocks that have just dropped out of bed when I got into them. Iconics Networks was one. It wasn't Networks. Iconics Incorporated was one a couple years back, year and a half back. I don't remember the exact price. Well, let me show it to you real quick. Let me pause the screen again. I just want to remind everyone real quick. Michael, I hope that answers your question about how this makes money. The break-even is a break-even, but it's only at expiration. We have a positive delta, so as the stock moves up, we're going to make money. And as the stock moves down, the put is hedging our losses. It's like insuring your house. If the property value goes up, you're great. If the property value drops, well, because of a fire or water damage, that's why you have insurance, right? That's what the radioactive trading principles start off with. I want to show you another interesting fact about that. It's kind of delved into radioactive trading position here, but I want to go, sorry folks, let me go here, screen in there. Okay, I'm going to go to radioactive trading. I'm going to look at one of my older positions. And this was on the Iconics position. It was a trade that I entered with for Fusion. It was posted live, and the Fusion subscribers could follow the trades as well as Ernie's trades and Greg Zarender's trades. Okay, and let me go to track record. I know you're not seeing this. I'm going to, there we go. Okay, so I'm going to go to track record. We're going to go to the Mike C at Power Out Portfolio. It's loading. It takes some time. It's got to go through the history prices and everything there. All right, and where am I? Here we go. So Iconics, when I got into it, originally I bought the stock at $36 and bought the August 40 put for $5.50, and this was on February 13th, 2 years ago, February 13th, 2015. And the stock dropped. Here, let's see, the stock dropped down to $33.95 from $36. Not too bad, but it was starting to drop. And then here, the stock is down to $21.70. So after this, I rolled down at $33.95 and lowered my cost basis. The COO, right before earnings, said he was leaving the company. Very shady. Maybe he didn't want to fudge some numbers that he was being asked to, and the stock dropped from 33 down to about 28. Then the earnings came out and it dropped down to about 22 or 20. You know, it was 23. And then the CEO said that he was going to leave right around this point at 21, right before this point at 21.70, and then of course the stock dropped again to 14.45. Now this is, sorry, where are my dates here? July 28th to August 10th. Went from 21.70 to 14.45. I eventually closed the position when the stock was at 12.25. So, I'm sorry, and that was on August 21st. Okay, so from 6 months, February to August, the stock dropped 66%. I made a profit of 4%. I was long stock the entire time. Okay, so that's one of the things that's possible. I'm not always right. This was a disastrous position. Is my goal 4% over a 6-month period? Absolutely not. But you know what? Had I been trading a covered calls and rolling down with the covered calls, that would have been a loss of 58%. Had I even been doing standard collars, with selling a call and buying a put, doing a standard collar position month by month, I did the math on it, how I would have rolled it, that still would have been a loss of 33% with rebracketing the collar and still moving the position. So this worked out. Had I done a strangle, I would have had a profit of 120%. You know, you can take it either way, really. But who knows what the future is as well. Michael, you're right. And it's, you know, the 12 different income methods we talk about at Radioactive Trading. Michael says, yes, but why sell covered calls on it when it goes up? You're shooting yourself and your profits. And that's right. There's 12 different adjustments we use on the married put position, okay, when the stock moves up or down. The first one is simple, just selling a call against it. And this married put, if the stock went up to maybe 37.50, 37.75 in the next couple of weeks, next couple of days even, I might look to sell the 38 call for maybe 70 cents or so. Okay. Why would I do that though? Well, what does that do? Now it lowers my risk and it gives me a potential profit here as well. I would only sell this call if I think the stock's going to stay now below this price or drop further. Now this price I got is just kind of extrapolated from a week from now. If the stock's at 37.80, the 37 call 2 weeks out right now is going for 79 cents, so I extrapolated if it moved up to 37.80, I could get maybe 80 cents for the 38 at that time. And you're right, it casts my gains. So why would I do this? Well, I'm back to the portfolio. I think I've already adjusted this call on ALLY, but I'm going to go to the profit and loss chart here. I got duped on this one. I'm going to be, sometimes you get duped. And it's okay, I'm still a profitable position. Oh, sorry. I'm still a profitable position here on ALLY, you know, with a potential short the 23 call and long the 23 put, so essentially a no-risk position. I've bulletproofed the position, so I can't lose if the stock falls, and I can make about 6.3%. I think I've been in this position since December, so it's averaging about 2.8, 2.9% return per month, taking in all of January and all of February and 15, 20 days of December. Okay, but I got duped on this one, and normally I don't like to sell the call, Michael, I agree with you, but I got duped on this one. And why am I not, I want to go to big charts here, and I'm going to set this up to a 3-month chart, about the time I've been in it, and I want to see some, I'll take the SMA 20, because I usually do Bollinger Bands, but instead of Bollinger Bands, I'm going to show earnings. I'm going to do MACD and RSI as well. Okay, I don't want to put volume in. Anyway, let's just keep this simple. Here we go. All right, so this blue line here, that's just the 20-day moving average. Why? This big chart is getting a little sloppy recently. The reason why I say that, I was in this trade, and you'd say, oh, well, here's your earnings. You know, you shouldn't have sold a call around earnings. And you're right, I didn't. Okay? I originally sold the 21 call, and then it just ramped up above it. Now I rolled it to the 23, so that's why I'm at the high profit, and I've bulletproofed the position. You see, here's a downturn. Earnings wasn't here. It was bizarre. Earnings was here 2 days before. The earnings came out and looked positive, and the next day, the stock didn't really move at all. But I had a 20 strike put, and the stock had been good because I got in about here, around 1950 with the 20 strike put, and at this point I rolled the 20 put up to the 21, and then here earnings came out and it didn't show any movement. It's very strange. It was kind of like a double dip. Not even a double dip, that's a terrible term. It was like a fake out. Earnings came out here. The next day the stock didn't move. So I've got my trends, I've got kind of my RSI here, it's meandering about, the volume was average, and I figured, well, this is a perfect time now to sell a 21 call. Here, after earnings came out, the stock didn't move. So I sold the 21 call, I had the 21 put, only got about 40 or 50 cents. 2 days after earnings, it gapped. I wasn't prepared for that. So it's just above 21, and I figured that's good. And then 3 days later, here the stock is at 23, and I'm holding the 21 put. So what does it do? It cost me $2 to buy this back, $2.20. And I roll up to the 23 call 1 month out. It went a little bit above that, but now it's starting to cross over on the MACD line, and it's starting to pull back down. So that's what I want. Okay, so when I sell the call, it's not because I'm still expecting growth. It's because I've seen the growth, and I'm expecting it to pull back. The earnings on this stock were positive, but it didn't move up the day after earnings. it stayed neutral. Kind of duped me. It did. It confused me. I figured it would have jumped up immediately. It didn't. It was the day after, the full trading day after the earnings, it gapped up overnight. Some other news, of course, in the financial market or discussion or posting about that. So why did I sell the 21 call originally? Because I thought the stock in the next 14 days from that point, since it didn't jump from earnings on a good earnings announcement, would stay below 21. That's the only time I sell a call if I think the stock's going to stay below that price. I had to roll it to the 23, which I did, because I didn't think it did go over it, but I didn't think it had enough strength to stay over 23 through March expiration. We're seeing a MACD crossover back on the chart, so I do think it's going to pull back. I'm hoping it pulls back. But yes, I see this crossover here, and the RSI is starting to dip down. It's starting to pull back down and show some weakness, getting closer to that 20-day moving average. So I do think it's going to pull back, and it might be at around $22.20, $22 by the time we hit March expiration. That's very speculative, and I'm not normally like that, but I'm not worried about it going over 23 right now. Why? Because even if it goes a little bit above 23 or to 24, I'm still in a good profit zone for the position, okay, for the amount invested in the position. And it's a bulletproof. Even if it gapped down now to $18 per share or $16 per share from some bad news overnight, earnings are past, I'm not worried about that, but even if it did, I'm guaranteed a profit of 1.3%. But you're right, this caps the gain. There are ways around it. There are other income methods we use that generate a premium but don't cap the gain in the radioactive trading techniques. Okay, you think, you know, sometimes you learn your lessons, sometimes you don't. I agree with you, Michael. Income method number one is probably my least favorite adjustment to use, but at the same time, it's one that's probably used more frequently just because it's the easiest thing to do to convert that married put into a collar by selling the calls, what you're doing. Excuse me, folks. Well, it is 5:32 p.m. Eastern Time. We are 2 minutes, of course, past the scheduled time. I don't see any other questions. However, if you do have a last-minute question, please feel free to go ahead and send that in to us. And Michael, I hope that I did answer your questions. Maybe I didn't answer them to convince you that this is a technique that you should be using in your account, but what I was showing you is just, yes, this is how we make money on the position. There is a break even, but that's only at expiration. And I agree with you. Selling the call isn't usually the best thing to do. If the stock continues to move against you, it's best to leave that upside open, but I was expecting a pullback because there was an initial jump after the earnings. It happened 2 days later, and it caught me completely off guard. I'll be honest with you. It happens to the best of us. And I'm not even saying I'm the best of us, but it happens to me too. All right. So if, while I'm waiting there to see if there, my apologies, folks, any other questions, let me just remind everyone, if you haven't done so yet, okay, if you're not currently subscribed or taking a trial to Power Options, remember, just go to poweropt.com, and then you can put in your first name, last name, and email address, and just click Start My Trial Now. We'll send you a password. You'll have full access to the search tools we looked at briefly today, the analysis tools, the portfolio, all of the tools in Power Options, especially the stock repair that we talked about in the beginning, and those other signature tools. You'll have full access to those for 14 days. Okay? And no credit cards needed, it's just first name, last name, and email address. And then, of course, after that, our subscription levels. We offer an end-of-day service where the data for the search and the analysis, the portfolio, and the tracking tools is only updated at the end of the day, and that's $40 per month. The most popular service, of course, is the delayed service, which gives you access to all the tools with 15-minute delay plus access to what Ernie created called the picks of the day for naked puts and covered calls, and the search results by email, and that's $60 per month. We do offer historical back testing, similar to the search that we use. You can plug in your criteria and run a search in a given strategy back in time to see which trades would have matched your default criteria. The 20-minute delayed with the historical is $100 per month, and of course the real-time service is $120 per month. So that anytime you refresh a page or run a search, you're getting the numbers and the calculations at that very instant. Okay? And then the full service gives you access to all the historical real-time data plus the programmer's interface, the API, and that's $160 per month. Why are the real-time and the premium so expensive? Believe it or not, for every year in the last 5 years, the exchanges, the NASDAQ, New York Stock Exchange, they increase their real-time distribution fees by about 40% every year for the last 5 years. It's become almost not economical to redistribute real-time data with the prices that they're asking for that. And it's on both of us too, which is ironic. What I mean by that is that if you sign up for the real-time service and you're just trading for yourself, well, technically we're getting charged an additional $80 or so for that service. So we take on some of that and you take on some of that. If you're actually a professional, a registered investment advisor, and you sign up for the real-time service, we pay that $80 or $90 that we're getting charged from NASDAQ for redistributing data, but then you have to pay them $120 in addition to what you're paying us and for other services, because they charge professionals more for receiving real-time data. It's frustrating. For our side of the business is a little frustrating with that, because it's just like health insurance. They have gone up almost 40% per year for the last 5 years. It's ridiculous. But that's why, unfortunately, the real-time price is expensive, because it's the redistribution fees. Now, next week we're going to have a couple of other webinars. We're going to have a power option strategy discussion on Wednesday at 12 noon Eastern Time. We're also going to have a couple of radioactive trading discussions. Tuesday at 12 noon we're hosting one calling Call the Market Top, how you can call the market top. It's not based on technical or fundamental indicators. You can register for that webinar by going to radioactivetrading.com, the lower right-hand corner of radioactivetrading.com. You'll see a link there to register for Tuesday's presentation at 12 noon. And at powerop.com, you can register for the Wednesday 12 noon presentation as well. In that webinar section, remember, go to that link I sent you, powerop.com/webinars.asp. You can go through some of our archives, specifically under the Options Concepts tab, manage your broken position, whether you have a covered call, a naked put that's down, or even the long stock, as we talked with Ben earlier in the presentation. Ladies and gentlemen, of course, if you do think of, I don't see any questions coming in at the end of our presentation, any last-minute questions, so just remind you, if you think of a question later, please feel free to send me an email to support@poweropt.com. You can also email me to support@radioactivetrading.com as well. And remember, you can also call us during market hours to talk to myself or to talk to Ernie. You can reach us at 302-992-7971, also toll-free 877-992-7971 during market hours. And those of you that are trial members or subscribers, remember you can schedule a free coaching session at any time with Ernie or myself. We'll walk you through the tools on the site and answer any questions that you have. All right, well, ladies and gentlemen, thank you for joining me this afternoon. I hope you found today's presentation useful to you. I hope you have a fantastic weekend, and I hope you have a good trading week next week. We'll see you hopefully live at one of our other presentations next week as well. So take care, everyone. Good night, and we'll see you soon.